Have you ever felt like you should be investing, but just the sheer amount of financial jargon just stops you dead in your tracks? You hear terms like equities, fixed income, NAV, and it feels like you need to learn a whole new language, right?
Oh, absolutely. It can feel like trying to decode some kind of secret message just to figure out how to, put your hard-earned money to work.
Exactly. Well, today, we're cutting through all that noise. We're going to pull back the curtain on one of the most common, yet maybe often misunderstood investment vehicles out there. We're asking, what exactly is a mutual fund and why does it seem to be absolutely everywhere, especially when you look at retirement accounts like 401ks? It's something millions and millions of Americans rely on, yet for so many, it's still a bit of a mystery.
And that's precisely our mission for this deep dive. We've taken a stack of your sources, everything from really foundational articles by leading financial institutions like Vanguard, Fidelity, BlackRock, to comprehensive guides from places like Investopedia and Wikipedia. Our goal here is really just to extract the most important, easy to understand nuggets of knowledge about mutual funds.
Right.
We want to make this complex topic simple, easy, and truly basic for you, our listener, so you can walk away feeling genuinely well-informed, confident about this crucial part of personal finance.
And we're going to uncover some really surprising facts and key insights along the way, too. For instance, we'll talk about why mutual funds are often called investment baskets and how they let you own hundreds, sometimes even thousands of companies with just one single purchase. It's pretty amazing when you think about it.
Yeah, it really is.
We'll also shine a bright light on the hidden costs and risks you need to watch out for, and crucially, how you can spot them and what they really mean for your long-term wealth.
Very important.
Plus, we'll dive into how mutual funds stack up against their close cousin, the ETFs, because that's a common point of confusion for so many investors, isn't it?
It absolutely is. A question we get all the time.
So by the end of this deep dive, you'll be equipped with practical knowledge and hopefully have those genuine aha moments that make understanding your finances not just easier, but actually kind of fascinating.
Let's do it.
Okay, let's unpack this. We're starting with the absolute foundation. What is a mutual fund?
At its core, it's a financial vehicle that pools money from many, many investors to purchase a diversified portfolio of securities. Now, that could be stocks, bonds, or even money market instruments. It's essentially a collective investment, isn't it?
That's exactly right. And, to make it really simple, think of it like a community garden.
Okay, I like that.
Instead of everyone buying their own tiny plot and trying to manage just a few plants, maybe, a couple of tomato plants and some basil.
Right, trying to keep everything alive yourself. Exactly. Instead, you and many others contribute money to this large, expansive, professionally managed garden. Now, you don't own the individual plants directly. You're not picking out that specific tomato plant or that rose bush hoping it thrives.
Okay.
Instead, you own a share of the whole diverse garden, and you benefit from everything growing in it. So, if one particular type of plant has a bad season, it's not the end of the world for your share because you have hundreds of other plants that might be flourishing.
Ah, that makes sense.
So when you buy shares in a mutual fund, you're buying a share of the fund itself. That makes you a partial owner of all its underlying holdings rather than needing to buy, hundreds of individual stocks or bonds directly yourself. This shared ownership is what makes it so accessible and honestly, so powerful for individual investors.
And what's growing in that garden, if we stick with the analogy, is chosen by an expert gardener, right?
Exactly.
These baskets are professionally managed. This isn't just some random collection of investments tossed together, is it?
Yeah.
So what does that professional management really mean for us as investors?
No, not at all random. It's actually quite the opposite. You're essentially hiring professional money managers, experts, to make investment decisions on your behalf.
Okay.
Imagine trying to research every single company, every bond, every potential market trend yourself. I mean, it would be a full-time job, right? It requires immense dedication and specialized knowledge.
Yeah, overwhelming.
Totally. So these fund managers and their teams of analysts do exactly that full-time. They are responsible for researching opportunities, selecting securities, constantly monitoring performance according to the fund's stated objectives. Some funds might aim for aggressive growth by investing in promising new companies. Others might focus on steady income from mature businesses or government bonds. And some just aim to mirror a broad market index.
Right.
Their continuous expert oversight saves you a colossal amount of time and effort. It's effectively putting a team of financial professionals to work for your money, even if you're starting small.
Which brings us to a super important point you mentioned, built-in diversification. our sources highlight that a major similarity between, say, ETFs and mutual funds is that they both represent these professionally managed collections of stocks or bonds, giving you that built-in diversification. So what does that really mean for lowering my risk? It sounds great, but how does it actually work?
Yeah. It's not magic, but honestly, it feels pretty close to it for individual investors. It simply means you're not putting all your eggs in one basket.
Okay.
Or, going back to our garden, you're not relying on just one type of crop. By spreading investments across a broad range of asset classes like stocks and bonds, different sectors, maybe technology, healthcare, energy, and even different geographies, US and international, the impact if any single security performs poorly is significantly reduced. For example, if one particular stock or bond in the fund tanks, well, there's a good chance that another 100 or maybe even 1,000 others are doing okay or even doing well. That potentially offsets those losses with gains elsewhere. This strategy inherently helps stabilize your portfolio, making your investment less susceptible to the wild swings of any single company or industry.
Right. That makes sense.
And for you, the individual investor, trying to achieve this kind of broad diversification on your own, it would be incredibly difficult and expensive. Can you imagine buying 500 different stocks just to mimic an
Oh,
index?
wow. Yeah, the fees alone.
Exactly. The transaction costs alone would be prohibitive for most people. A single mutual fund handles all of that for you, making sophisticated diversification incredibly accessible and cost-effective. That's often a huge aha moment for new investors, realizing they can get this powerful risk management benefit with relative ease.
And it's no exaggeration to say that for millions of Americans, mutual funds really are the cornerstone of their retirement savings. They truly are everywhere you look in finance.
Indeed. The prevalence is astounding. The number of American households invested in mutual funds has increased dramatically over the last half century or so. Back in 1980, it was only about 6% of households. Fast forward to the mid-2020s, and that number has jumped significantly to about 53%.
Wow, that's a huge jump.
It really is. And get this, what's even more fascinating and speaks to their central role in personal finance here in the US is that approximately 88% of all mutual fund assets are actually owned by American households.
80%.
88%. And they're particularly prevalent, often the default choice, in 401ks and other similar employer-sponsored retirement plans. They account for roughly 50% of the assets held in those types of accounts. They truly are foundational to personal finance in the US, just silently working behind the scenes for millions of people.
And here's where it gets really interesting historically. Mutual funds aren't actually a new invention. The first modern investment funds were established way back in the Dutch Republic. We're talking the 1770s. And their purpose? To help small investors diversify their holdings across different ventures.
Incredible, isn't it?
Talk about foresight. It shows that the core need for diversification and pooled investing is centuries old.
Absolutely. The concept has deep roots, but the modern iteration we know today really took shape here in the US. The very first open-end mutual fund in the US was the Massachusetts Investors Trust. It was founded in 1924.
Wow.
And believe it or not, it's still around today, which demonstrates incredible longevity.
That's amazing.
And the growth and broad acceptance of mutual funds in the U.S. was significantly spurred by critical regulations, things like the Securities Act of 1933 and the Investment Company Act of 1940. These acts established really important rules for transparency, accountability, and how these funds had to operate. They basically laid the legal groundwork that helped build trust among investors, ensuring funds operated fairly and openly. And that, in turn, allowed the industry to grow responsibly into the behemoth it is today.
Okay, so we've defined what a mutual fund is, why it's such a foundational investment vehicle, especially here in the U.S. But how do these funds actually work day to day? What's happening inside that basket that ultimately, hopefully, puts money in your pocket? We know there are experts at the helm managing these funds, but what exactly are they doing with your money? Are they all doing the same thing, or are there different philosophies at play here?
That's a great question, and the answer is no. They're definitely not all doing the same thing. There are two main management styles for mutual funds, and understanding this difference is really crucial. First, you have actively managed funds.
Right.
These managers, and often their large teams of analysts, are essentially trying to be financial detectives. They use their expertise, extensive research, economic forecasts, all of that, to try and beat the market. Or more specifically, to beat the fund's benchmark, like the S&P 500 index, for example.
Yeah.
They are actively researching individual companies, selecting specific securities they believe will perform exceptionally well, and constantly adjusting the portfolio by buying and selling based on their insights. They're making strategic decisions daily, trying to get superior returns.
Trying to find the winners.
Exactly. Then on the other side, you have index funds.
Okay.
These funds are designed to simply track rather than beat a specific market index, such as the S&P 500 or maybe the Dow Jones Industrial Average. Think of it like this. If the S&P 500 holds the 500 largest U.S. companies in specific proportions, an S&P 500 index fund will hold those same 500 companies in roughly those same proportions.
Just mirroring it.
Precisely. While they are often called passively managed, they still have managers, but their role is basically to ensure the fund aligns perfectly with its target index, not to pick individual winners. Now, what's fascinating here, and maybe a bit counterintuitive for some investors, is that while actively managed funds aim to outperform, index funds frequently offer market returns at significantly lower costs. Why? Because there's less active trading and research involved.
Lower fees.
Exactly. And often, these index funds actually outperform actively managed funds over long durations precisely because their costs are so much lower. That's a really powerful insight that often surprises people and has led to a massive shift in how many people invest their money towards these lower-cost index options.
That's a really crucial distinction, especially for a new investor. Okay, so if I decide to buy into one of these funds, how is the price of my mutual fund shares determined? Is it like a stock that changes price every second on a trading screen?
No, not at all. And this is a key difference from individual stocks or even ETFs, which we'll definitely talk more about later. The price of a mutual fund share, which is also known as its net asset value or NAV.
NAV, right. Heard that one?
Yep, NAV. It's calculated only once a day after the market closes, typically around 4 p.m. Eastern Time. Think of it as taking a snapshot at the end of the day. The NAV is derived by taking the total value of all the securities in the fund's portfolio, all the stocks, bonds, everything it owns, subtracting any liabilities or expenses the fund has, and then dividing that total by the total number of shares outstanding.
So it's a calculation at the end of the day.
Exactly. So if you put in an order to buy or sell a mutual fund at, say, 10 a.m., it won't actually execute until after the market closes later that day, and you'll receive that single end-of-day NAV price. This means everyone who buys or sells shares in that mutual fund on any given day, as long as they get their order in before the market closes, gets the exact same price.
Okay, that simplifies things. No need to watch the screen all day.
Precisely. It simplifies the pricing for investors, so you're not constantly watching tick-by-tick movements like you might with an individual stock.
Okay, so you're investing. You definitely want to know, how do you actually make money in these funds? What are the pathways to profit beyond just, hoping the value goes up?
All right, good question. You typically earn returns from a mutual fund in 3 primary ways, and it's really helpful to understand all 3 to get the full picture of your investment's potential. The first way is through dividend and interest income.
Okay.
Just like individual stocks might pay dividends or bonds pay interest, the stocks and bonds held within the mutual fund generate this income. These payments are collected by the fund, and then they're distributed to you, the investor. You often have a choice. You can receive this income as a direct cash deposit into your account, or, and this is a very popular choice for long-term growth, you can automatically reinvest it to buy more shares in the fund.
Compounding.
Exactly. That reinvestment helps compound your returns over time. More shares earning more income. The second way is through capital gains distributions.
Okay.
Remember those fund managers, especially in actively managed funds, who are buying and selling securities. Well, if the fund manager sells any securities within the portfolio for a profit, meaning they bought them low and sold them high, these capital gains are typically passed on to you, the shareholder, as a distribution, usually once a year. This is basically a direct payout of the fund's trading successes.
Got it.
And finally, the third way is through capital gains from selling your own shares. If the overall value of the fund's underlying holdings increases, if those stocks and bonds become more valuable than the price of your mutual fund shares, its NAV rises. When you eventually decide to sell your shares for more than you originally paid for them, you realize your own capital gain.
Okay, so income, fund gains, and my own gains.
That's it. And when you're researching a fund, you'll often see a total return figure. This comprehensive number includes all 3 of those income streams, any interest received, dividends paid out, and any changes in the fund's market value, the NAV, over a specific period. And a quick tip. While short-term performance might grab headlines, most experts will tell you it's really best to look at longer-term performance, like 3-year and 5-year returns, maybe even 10-year returns, to get a much clearer, more reliable picture of how a fund is truly performing over time. Don't get too caught up in the day-to-day fluctuations.
That's great advice. Understanding the how is vital. But the why, the compelling advantages that draw so many investors to mutual funds, that's what truly makes them shine. Let's dive into those benefits because they really explain why these are such a popular choice for so many people.
So the first big win is diversification. We've talked about it, but what does that really mean for me as an investor, especially if I don't have a massive amount of money to start with? How does it actually protect my money day to day? It means a huge amount, especially for individuals who are building wealth over time. As we touched on, a mutual fund automatically gives you a diversified portfolio, often holding hundreds or even thousands of individual stocks or bonds. Now, this isn't just about, spreading your money around randomly. It's about strategically mitigating risk. Imagine you bought stock in just one company, and that company suddenly goes bankrupt or hits major trouble.
Yeah, scary.
Your entire investment could be wiped out, potentially. But if you own a mutual fund that holds shares in, say, 500 different companies, even if one of them performs poorly, its impact on your overall investment is significantly softened, diluted, really by the performance of the many other holdings in the fund.
Right, the others cushion the blow.
Exactly. This built-in diversification is one of the most powerful advantages, especially for individuals starting with a modest amount of money. Think about it again. Building a similarly diversified portfolio yourself would be incredibly time-consuming and expensive. Remember those transaction costs for buying hundreds of stocks?
Yeah, forget about it.
Right. A mutual fund handles all of that heavy lifting for you, making sophisticated diversification incredibly accessible and cost-effective. That's a huge aha moment for many new investors, realizing they can achieve this crucial risk management without needing a huge amount of capital or becoming a stock-picking genius.
And then there's the professional management aspect. We've established there were experts managing our money, but how does that really benefit someone who might not have the time or, frankly, the desire to track markets daily? Is it always a good thing to just hand over the reins like that?
For most people, it's immensely beneficial. You get the benefit of full-time professional money managers and their dedicated teams of analysts who are constantly doing the hard work, researching companies, analyzing market information, making complex investment decisions day in and day out. They identify which securities to buy and sell through rigorous evaluation, sector allocation, analysis of various technical and fundamental factors, all the stuff most individuals just don't have the time or expertise for. For you, this means you don't need to be a market expert yourself. You don't need to spend hours poring over financial statements or economic reports. The fund's objective is continuously monitored and adjusted by experienced professionals, saving you immense time and effort. It's like having a top-tier financial team working for you, constantly adapting to market changes, even if you're investing at just a small amount each month.
That's a huge relief for many people, I bet.
Absolutely. Now, to your question about downsides, while professional management is a huge benefit, it doesn't automatically guarantee superior returns. As we discussed, actively managed funds try to beat the market, but that active management comes with higher fees. And sometimes, maybe even often, even the experts don't succeed in outperforming simple, low-cost index funds over the long term, especially after you factor in those higher costs.
So you still need to pay attention to the costs.
Absolutely. While you hand over the reins for the day-to-day decisions, you still need to be aware of the fund's strategy, its objectives, and definitely its costs.
Okay. Another advantage mentioned is economies of scale. Now, that sounds like a big business term. How does it apply to my investment in a mutual fund? Is it just about saving a few pennies here and there?
It's definitely more than just a few pennies. It's about leveraging collective buying power to your advantage, and it can add up significantly over time.
How so?
Because a mutual fund pools money from thousands, sometimes millions of investors, it can buy and sell massive amounts of securities at a time. Think about buying groceries. If you buy a single apple, it costs a certain amount. But if you buy a whole crate directly from the orchard, the cost per apple is often much lower.
Yeah, bulk discount.
Exactly. It's like a bulk discount for investing. This volume means the fund's transaction costs, things like brokerage commissions for buying and selling stocks, are typically much lower per share than what you would pay if you were buying individual stocks one by one, making maybe just a few trades. This collective buying power translates directly into significant cost savings that stay within the fund, ultimately benefiting you, the individual investor, over time. It means more of your money is working for you, not being eaten up by trading costs.
Okay, lower trading costs. Makes sense.
And there's an added benefit. This scale also allows mutual funds to access certain assets or take larger positions in investments that might otherwise be unavailable or impractical for individual investors. It opens up more opportunities.
That's a great point. So once my money is in, is it easy to get my money in and out if I need it? We're talking about liquidity and convenience here. How does that work? Is my money locked up?
No, generally not locked up. That's another big plus. Mutual funds are generally highly liquid investments. That means you can redeem or sell your shares on any business day the market is open.
Okay, good to know.
This ease of access is a significant advantage compared to, say, real estate or certain other less liquid investments. You're not typically locked into a fixed term. Furthermore, one of the biggest conveniences, especially for building long-term wealth, is the ability to set up automatic investments. You can arrange for regular purchases, maybe $100 from every paycheck, or $500 once a month to go directly into your chosen fund.
This set it and forget it approach.
Exactly. It happens automatically without you lifting a finger. This is a huge plus for long-term savings goals like retirement. It enforces discipline, ensures you consistently contribute to your financial future, and allows you to benefit from something called dollar cost averaging, buying more shares when prices are low and fewer when they're high, automatically.
And you mentioned accessing different markets.
Yes, they also provide relatively easy access to markets that might be difficult or complex for individual investors to navigate on their own, like certain foreign stock markets or niche bond categories. It simplifies getting that global exposure.
That convenience sounds great. But how do I know these funds are trustworthy? What kind of transparency and government oversight is there, especially since it's my retirement savings or other important money at stake?
This is a really critical advantage of mutual funds, especially compared to some other less regulated investment options you might hear about. Mutual funds operate under strict governmental oversight. Particularly here in the United States, they're regulated by the SEC, the Securities and Exchange Commission. And the SEC pays very close attention to how these funds are run, precisely because of their importance to so many Americans' retirements and savings.
Okay, so there are rules.
Strict rules. Funds are legally required to publish detailed information regularly. This includes things like their past performance, how they compare to relevant benchmarks, a full breakdown of all the fees they charge, and crucially, the specific securities they hold in their portfolio. You can actually see what you own.
That's good transparency.
Exactly. This high level of transparency is designed to ensure accountability and fairness for you, the investor. It also makes it much easier for you to research and compare different funds side by side before you invest. This mandated disclosure gives you a significant advantage in understanding exactly what you're investing in, fostering trust and providing built-in safeguards for your interests.
So, summing up the advantages: diversification, professional management, cost savings through scale, convenience, liquidity, and strong oversight. It's clear why they're popular. But with literally thousands of options out there, it can still feel like trying to find a needle in a haystack. How do you even begin to choose the right one for you?
Let's break down the different types you're likely to encounter, like creating a map to navigate this world. Now, this is where it can feel a bit overwhelming, I think, for a lot of people, thousands of funds. But you're saying it's much simpler if we break them down into main categories, right? What are the big buckets we should know about? Exactly. You're right. Seeing over 800 mutual funds can seem daunting, but most fall into just a few core categories, which makes them much easier to understand and navigate. The four primary types are stock funds, which are also commonly called equity funds. Remember that jargon term, equities, we mentioned. That's what we're talking about here. Funds that invest primarily in company stocks.
Got it. Stocks.
Then we have money market funds, which are very short-term, low-risk funds. Then bond funds, also called fixed income funds, focusing on debt. And finally, target date funds, which are often grouped under a broader category called hybrid funds because they combine different asset types like stocks and bonds.
Okay. Stocks, money market, bonds, target date.
Those are the big four. It's also worth noting that most mutual funds belong to larger investment companies, often called fund families. You'll recognize names like Vanguard, Fidelity, T. Rowe Price, Schwab. These companies manage many different funds under one umbrella, often with similar investment philosophies or fee structures.
Okay, let's dive deeper into these specific fund types, starting with those target date funds. These sound really amazing for retirement saving, right? That whole set it and forget it strategy seems like a dream for busy people.
Absolutely. Target date funds are remarkably straightforward and honestly, powerful approach to retirement investing. That's precisely why they are so incredibly popular, especially as the default option in many 401k plans. They're typically named with a specific year in the future, like Target Retirement 2045 or Target Retirement 2050, which signifies your approximate planned retirement date.
Makes sense.
The brilliance of these funds, the real magic, if you will, is that they automatically adjust their mix of investments, typically stocks, bonds, and maybe some cash equivalents over time as you get closer to that target year.
How does that work?
It's often referred to as a glide path. Think of it like an airplane gradually descending for landing. Early in your career, when you have many years, maybe decades, until retirement, the fund might be quite aggressive. It'll invest heavily in stocks, aiming for maximum growth potential to build your wealth over the long term.
More stocks early on.
Right. But as you get closer to your target retirement year, say, within 10 or 15 years, the fund automatically and gradually shifts more of your money into more conservative investments, like bonds and cash. The goal here shifts from aggressive growth to capital preservation. It's about helping to protect your nest egg from major market downturns when you have less time to recover from potential losses before you need the money.
So it gets safer automatically as you get older.
Precisely. This automatic rebalancing means you don't have to constantly monitor your portfolio or make complex decisions about shifting assets yourself. The fund does it for you. And it's incredibly common. More than 90% of employee retirement plans in the U.S. now use target date funds as their default investment option. That just highlights their immense popularity for hands-off long-term saving. They truly simplify retirement investing by building a sensible, age-appropriate strategy right into the fund itself.
Okay, that's target date. What if I want to invest directly in the stock market? Maybe be a bit more specific, but still want that diversification and professional management. That's where stock funds come in, I presume. Can you simplify the different types of stock funds for us? It seems like there are a lot of labels there, too.
That's exactly right. Stock funds or equity funds are your vehicle if you want broad exposure to the stock market. They invest principally in company stocks or equities. And yes, they're often categorized in a few key ways to help investors understand their focus. One common way is by the size of the companies they invest in. This is often known as market capitalization, or market cap, basically, the total value of a company's stock.
Market cap.
Okay, so you'll see large cap funds. These invest in giant, well-established companies, often household names, typically with over $10 billion in market value. Think of recognizable blue-chip firms like Apple, Microsoft, Johnson & Johnson. They're generally considered more stable.
The big guys.
Exactly. Then you have small cap funds. These focus on newer, smaller companies, typically with market values between maybe $250 million and $2 billion. These tend to be more volatile, potentially riskier, but they can also offer higher growth potential if they succeed.
Higher risk, maybe higher reward.
Potentially. And in between, naturally, you have mid-cap funds investing in companies that fall between the large and small categories, often in that $2 billion to $10 billion range. Another way stock funds are categorized is by their investment approach or style, reflecting the fund manager's philosophy on how to pick stocks.
Okay, style, like growth or value.
Precisely. Value funds typically focus on stocks the manager believes are undervalued by the market. They're looking for solid companies that might be temporarily out of favor, maybe with low price-to-earnings ratios, aiming for a long-term appreciation when the market eventually recognizes their true worth. Think bargain hunting.
Looking for deals.
Right. Growth funds, on the other hand, seek companies with strong growth metrics, rapidly increasing earnings, sales, cash flow. These are often exciting, maybe newer companies, perhaps in technology or healthcare, that might have high valuations because investors expect great things from them in the future. They often reinvest profits back into the business rather than paying big dividends.
Betting on future expansion.
Exactly. And if you can't decide or want a mix, there are blend funds. These offer a compromise, investing in a mix of both growth and value stocks. And of course, these stock funds can also be categorized simply as U.S. stock funds or international stock funds, giving you exposure to companies based here or in other countries around the world. For a new investor, just understanding these broad buckets size and style is usually enough to start, rather than trying to memorize every single subtype right away.
Okay, that helps break it down. Now, for something perhaps less volatile than stocks, maybe focus more on consistent income rather than maximum growth. What about bond funds?
That would be bond funds, also known as fixed income funds. That term fixed income gives you a clue. These funds focus on investments that typically pay a set or fixed rate of return over a period of time.
Like loans, basically.
Essentially, yes. They invest in things like government bonds, issued by the U.S. Treasury or other governments, corporate bonds, issued by companies to raise money, municipal bonds, issued by states or cities, and other types of debt instruments. Their primary goal is usually to generate consistent interest income, which is then passed on to you, the investor, the shareholder, typically on a regular basis, maybe monthly or quarterly.
Okay, steady income focus. Are they safer than stock funds?
Generally speaking, yes, bond funds tend to be less volatile than stock funds. Their prices don't usually swing up and down quite as dramatically. However, it's really important to remember they are not risk-free. All bond funds have interest rate risk. This is a key concept. If interest rates in the broader economy rise, the value of existing bonds that are paying lower, fixed interest rates tends to fall. Why? Because new bonds are now being issued at higher rates, making the older, lower-paying bonds less attractive. This directly impacts the bond fund's price, or NAV.
Ah, so rising rates hurt bond fund prices.
Generally, yes. The opposite is also true. Falling rates tend to help bond prices. Also, not all bonds are created equal in terms of risk. A bond fund specializing in high-yield junk bonds, which are issued by companies with lower credit ratings and a higher risk of default, is significantly riskier than a fund investing primarily in super-safe U.S. Treasury bonds.
So you need to look at what kind of bonds are in the fund.
Absolutely. It's not a one-size-fits-all category in terms of risk. You need to look at the quality and type of bonds the fund holds to understand its true risk profile.
Okay. Now, we touched on these earlier, but they're worth a deeper dive, given their immense popularity and, as you said, perhaps surprising performance. Index funds. They're often called the passive powerhouse, and it sounds like for good reason, right?
Absolutely. Index mutual funds have revolutionized investing for many people. As we discussed, they are specifically designed to replicate the performance of a specific market index, like the popular S&P 500, which tracks 500 of the largest U.S. companies. They do this by simply holding the same companies that are in the index in roughly the same proportions. This is a passive strategy. The managers aren't trying to actively pick winning stocks or time the market. They're just mirroring a widely accepted benchmark.
Less guesswork involved.
Right. And because of this passive, low-intervention approach, they tend to have significantly fewer expenses passed on to investors through fees. Remember that crucial expense ratio. Index funds are often leaders in low costs.
Lower fees are always good.
Definitely. And here's that significant insight again, which often gets overlooked. Index funds frequently outperform actively managed mutual funds over the long term. This isn't a guarantee, naturally, but history shows that many, perhaps even most, actively managed funds struggle to consistently beat their benchmarks, especially once you factor in their higher fees. So index funds, by simply tracking the market at a very low cost, can offer that potentially rare combination of lower costs and often better, or at least reliably market-matching performance. That's why they're so incredibly popular with cost-sensitive long-term investors who believe it's hard to consistently beat the market.
Makes a lot of sense. What about something for really short-term savings? Maybe for cash you're holding before investing it elsewhere, or perhaps as part of an emergency fund. Is there a mutual fund for that?
For that specific need, you'd typically look at money market funds.
Money market. Okay.
These funds invest in very safe, highly liquid short-term debt instruments. Think things like government treasury bills, very short-term government debt, high-quality commercial paper, short-term debt from corporations, or bank certificates of deposit, CDs. The returns aren't substantial, usually a little bit more than you'd get in a regular bank savings account, but typically less than you might get from a longer-term CD. But the trade-off is that they are considered very low risk due to the short maturity, meaning they get paid back quickly, and the high credit quality of their holdings.
So safe, but not high return.
That's the profile. They're often used as a temporary holding place for cash. Maybe money you plan to use for future investments soon, or cash you've just received from selling something else, or as a stable, easily accessible component of an emergency fund.
But you mentioned a caveat before.
Yes, and this is a crucial one. It's vital to remember that unlike your bank savings accounts or CDs, money market funds are not insured by the Federal Deposit Insurance Corporation, or FDIC.
Not FDIC insured. Got it.
While they are generally considered very safe and losses are extremely rare, there is a theoretical possibility, it's happened only a couple of times in history, that the fund's share value could fall below the standard $1 NAV. This is called breaking the buck. So while very low risk, they don't have that same government guarantee as a bank deposit. That's a key distinction to keep in mind. And just quickly, Beyond these main four categories, there are also a few other notable mutual fund types worth a brief mention, just so you might recognize the names if you see them. We have balanced funds, which are hybrid funds. They invest across different asset classes, maybe 60% stocks, 40% bonds, for example, to provide both growth and income while diversifying and aiming to reduce risk.
A mix in one fund.
Exactly. Income funds are specifically designed to, well, generate income. They might do this by holding bonds until maturity or investing heavily in high dividend-paying stocks. International or global funds focus outside the U.S. International funds invest solely in assets outside your home country, while global funds can invest anywhere worldwide, including your home country. Great for geographic diversification. Sector and theme funds concentrate on specific industries like technology, healthcare, or energy, or maybe broader investment themes like artificial intelligence or clean energy. These are usually more focused and potentially riskier than broad market funds.
More specialized.
Right. And increasingly popular are socially responsible mutual funds, also known as ESG funds. These invest in companies that meet specific environmental, social, and governance criteria,
Wow.
allowing you to align your investments with your personal values.
Lots of options there.
A huge variety, really catering to almost any investment goal or preference.
To make this even more concrete, let's look at a few examples of real funds that our source has highlighted, just to give our listeners a flavor of what they might actually encounter when they start looking.
Certainly. Seeing real examples helps solidify these concepts. Some prominent ones that illustrate these types and their characteristics include, for instance, the Vanguard 500 Index Fund. Its ticker symbol is often VFIAX for the Admiral Shares class. This fund, as the name suggests, tracks the S&P 500 index. It's known for having a remarkably low expense ratio, around 0.04%.
Wow, that is low.
Which means you pay just 40 cents a year for every $1,000 invested. It typically requires a $3,000 minimum initial investment for those Admiral shares, though other share classes might have different minimums. A very similar option is the Fidelity 500 Index Fund, ticker FXAIX. It also tracks the S&P 500 but boasts an even lower expense ratio, currently around 0.015%.
Even lower.
Yes, incredibly low. And importantly, it has no minimum investment requirement, making it extremely accessible for people just starting out.
No minimum, that's great.
For global diversification, there's an interesting one. The Fidelity Zero International Index Fund, FZILX.
Ooh.
The zero in the name is key. It impressively sports a 0% expense ratio.
0%. How do they do that?
It's a strategy Fidelity uses to attract assets, essentially making money in other ways. But for the investor, it means no ongoing management fees for that broad international stock exposure. Amazing value. And for broad exposure to the U.S. bond market, a classic example is the Vanguard Total Bond Market Index Fund, VBTLX. It gives you exposure to thousands of U.S. bonds, also has a very low 0.04% expense ratio, and typically a $3,000 minimum. These real-world examples just show how mutual funds, especially index funds from major providers, can be both highly diversified and remarkably cost-effective, depending on the specific fund family and type you choose.
That's a lot of options. But hearing those real examples with the costs and minimums makes it so much clearer. Okay, so now that you, our listener, have a better grasp of the different kinds of mutual funds available, let's turn our attention to the practical steps. How do you actually go about investing in them? How do you get started? So you're ready to dip your toes in. What's the very first thing to consider, even before you start looking at specific funds or thinking about opening a brokerage account? What's the absolute smartest first move?
The smartest first step, honestly, before you do anything else, is to check with your employer. See what they offer.
Your job. Why they're first?
Because many employers offer mutual funds through retirement savings plans like 401k or maybe 403ds if you work for a nonprofit, or similar plans. And crucially, these often come with matching funds from the employer.
Ah, the company match.
Exactly. This is essentially free money. Your employer might contribute, say, 50 cents for every dollar you put in, up to a certain percentage of your salary, or maybe even dollar for dollar up to a limit. It's literally like doubling your money instantly, a guaranteed return on investment from day one that you just can't beat anywhere else. You should always try to contribute enough to get the full employer match if one is available. It's the easiest way to jumpstart your savings with minimal effort and maximum benefit. Don't leave that free money on the table.
Absolutely critical advice. Okay, but what if my employer doesn't offer a plan? Or maybe the funds in their plan aren't what I'm looking for? Or what if I want to invest outside of a retirement plan, maybe for a down payment on a house or just general savings?
Right, good question. In that case, you'll need to open your own investment account, typically called a brokerage account.
Okay, brokerage account. Where do I get one of those?
Think of a brokerage account as your personal platform for buying and selling investments like stocks, bonds, ETFs, and mutual funds. You can open one easily online with many reputable firms. Major players include Fidelity, Charles Schwab, Vanguard, E-Trade, and others. The process is usually pretty straightforward, similar to opening a bank account online. Once you have that account set up, you'll need to fund it, deposit money into it. Make sure you have enough deposited to cover the minimum investment requirements for the specific mutual funds you're interested in buying.
Right, those minimums we talked about.
Exactly. While some funds, particularly certain index funds or ETFs from large providers, might have no minimum or very low minimums, many mutual funds, especially actively managed ones, might have initial minimums like $1,000, $3,000, or sometimes even higher. So it's always important to check that specific requirement for the fund you want before you try to buy it.
Okay, account opened, money deposited. But with all those fund types we just discussed, stock, bond, target date, index, value, growth, how do I possibly pick the right one for me in my financial situation? It can still feel like a vast ocean of choices.
This is truly crucial, and there's no single best fund for everyone. It's all about tailoring your choices to your unique circumstances and goals. You really need to identify mutual funds that genuinely match your investing objectives. First, think honestly about your risk tolerance. Are you comfortable with the possibility of larger ups and downs, higher risk for the potential of higher long-term returns? Or do you prefer something more conservative that aims for steadier, maybe lower, returns and focuses more on preserving your capital? There's no right or wrong answer, it's about what lets you sleep at night.
Okay, risk tolerance first.
Second, consider your time horizon. How long do you plan to keep the money invested? Are you investing for retirement that's decades away? If so, you generally have more time to ride out market fluctuations and can potentially afford to take on more risk. Or are you saving for a down payment on a house you hope to buy in just 3 years? That requires a much more conservative approach, likely leaning towards bonds or even money market funds because you can't risk a big drop right before you need the cash.
Time horizon makes a big difference.
Huge difference. And very importantly, always look at the fees, especially that expense ratio, and the minimum investment requirements we just discussed. High fees can significantly erode your returns over time. The good news is many online brokerage platforms offer excellent fund screening tools. These let you filter the thousands of available funds based on these very criteria you can screen by fund type, stock, bond, etc., risk level, expense ratio, minimum investment, past performance, and more. These tools can really help you narrow down the vast universe of options to a manageable list that fits your specific needs, making the selection process much less daunting.
Those screeners sound really helpful. Okay, so I've used the screener. I've thought about my goals. I've chosen a fund that seems like a good fit. What's next for actually placing the investment? Is the buying process complicated?
No, it's usually surprisingly simple once you have your account set up and funded. You basically just determine how much money you want to invest in that chosen fund, whether it's your initial lump sum or a smaller recurring amount. Then you simply submit your trade order through your brokerage platform's website or app. It's typically as easy as selecting the fund by its name or ticker symbol, like VFAX or FXAIX we mentioned, entering the dollar amount you want to invest, and clicking buy or submit.
Pretty straightforward.
Very. And to truly embrace that powerful set it and forget it approach for long-term goals, you can almost always set up automatic periodic purchases. This means you tell the brokerage, invest $200 from my linked bank account into this fund on the 15th of every month. The system then does it automatically for you, building your investment consistently over time without you having to manually remember to log in and place the trade each time. This automation is a huge convenience for long-term investors. It enforces discipline and takes advantage of that consistent investing strategy, regardless of whether the market is up or down that particular day.
That automation seems key for consistency. Okay, so I set up my automatic investment. Do I just invest and forget about it entirely then? Or is there still some level of engagement required for me over the years?
That's a great question. While mutual funds offer professional management and are often designed for long-term investing, you definitely don't need to watch them daily. It's still wise to periodically check in on your investments.
Nice.
Think of it like checking in on that community garden again. You don't need to be there every single day pulling weeds, but maybe a seasonal checkup, Perhaps once or twice a year is a good idea. Market conditions change. New funds might emerge that are better or cheaper. And, crucially, your own personal goals or financial situation might evolve over time. Maybe you get a raise and can invest more. Maybe your risk tolerance changes as you get older. Maybe your time horizons shift.
Right, life happens.
Exactly. So a good rule of thumb is to review your portfolio maybe once a year, or perhaps whenever there's a significant life event like a new job, getting married, having kids, or nearing retirement. Just take a look. Is this fund still performing reasonably well compared to its peers or benchmark? Does it still align with my goals? Are the fees still competitive? You don't need to panic over short-term movements or constantly tinker, but a regular check ensures your investments remain on track and suitable for you. And then, of course, when it's finally time to use the money, maybe for retirement income or that house down payment or sending a kid to college, you simply log into your brokerage account and enter a sell order for the shares you need. The fund will be redeemed at that day's closing NAV, and the cash will typically appear in your account within a few business days.
Okay, so periodic review, not constant obsession. Got it. The steps to get into mutual funds seem quite straightforward, actually. But now let's turn to the critical part. Understanding the potential downsides, the risks involved, and especially those fees that can eat into your returns. This is where diligent attention really pays off, because these are the details that truly impact your long-term wealth accumulation. We hear a lot about investments having risks. What are the specific risks with mutual funds that an investor absolutely needs to be aware of, beyond just the general idea that the market can go down?
This is probably the most important point to grasp right up front because it's where mutual funds differ significantly from, say, putting money in a traditional bank savings account. Ready?
Ready.
Mutual funds are not insured by the Federal Deposit Insurance Corporation, FDIC.
Okay, say that again, not FDIC insured.
Correct. Unlike money you put in an FDIC-insured bank account, where your deposits are typically protected by the government up to $250,000 per depositor per bank. With mutual funds, there's no such guarantee. There's always the possibility that the value of the stocks or bonds held by the fund will go down, causing the fund's NAV, the price of your shares, to depreciate. You could lose some, or in extreme cases, even all of your invested money. This isn't saying it will happen, but it is a fundamental possibility, a risk you must understand and accept when you invest.
That's a huge distinction from a savings account.
Absolutely fundamental. Beyond that core risk, there's market risk. This is the broad risk that the entire stock market or bond market declines due to economic events, political turmoil, or other factors. If the overall market goes down, the value of the securities held within your fund is likely to decrease too, pulling down your fund's value. You can't really diversify away market risk entirely. Then, specifically for bond funds, as we discussed, there's interest rate risk. If interest rates in the broader economy rise, the value of existing bonds held by the fund, which are paying lower interest rates, can fall. This directly impacts the bond fund's price.
Got it, the seesaw with rates.
Exactly. And finally, there is management risk. While having professional management is generally a significant advantage, you are ultimately putting your money and trust in the hands of the fund manager and their team. Poor investment decisions on their part, or a strategy that simply underperforms its peers or benchmark, will negatively impact your returns. So while you get expertise, it's not an infallible guarantee of stellar performance. They can make mistakes too.
Okay, those are the big risks. What about some of the operational quirks or potential drawbacks of mutual funds that might not be immediately obvious? I think you mentioned something called cash drag earlier.
Yeah.
What is that, and why should I care?
Right. Cash drag is an interesting one that often surprises investors when they learn about it. To maintain liquidity, meaning to have cash readily available to pay investors who want to sell their shares without being forced to sell underlying stocks or bonds constantly, especially at bad prices, mutual funds typically have to keep a certain percentage of their portfolio in cash.
Makes sense, they need cash on hand.
They do. But the issue is this cash generally earns very little or no return, especially in low interest rate environments. So this pool of cash acts as a drag on the fund's overall performance. It essentially pulls down the total return of the fund slightly, even if the invested portion of the portfolio, the stocks and bonds, is doing quite well, because a part of your money isn't really working as hard as it could be.
Oh, so some money is just sitting there not growing.
Pretty much. It's a necessary operational feature for liquidity, but it can slightly dampen performance compared to, say, an investment that stays 100% invested all the time. Here's another concept that might surprise you, often called dilution, particularly relevant for very successful popular funds.
Dilution, how does that work?
This can happen when a very successful fund, maybe one with a star manager who has had amazing returns, attracts a huge influx of new money from eager investors. Now, that sounds like a good thing, right? Success breeds success.
Seems like it.
But sometimes, if billions and billions of new dollars suddenly flood into the fund, the manager can actually have trouble finding enough new, high-quality investment ideas to put all that capital to work effectively, especially without driving up the prices of the stocks they want to buy. This massive inflow of cash can sometimes dilute the fund's ability to achieve the same kind of outsized returns it had when it was smaller and more nimble. The new money might not be put to equally good use, making it harder for the fund to deliver the same stellar performance it became famous for. It can become a victim of its own success, in a way.
Interesting. Too much money can be a problem.
It can be for active managers trying to find unique opportunities. And just to reiterate that key operational difference we mentioned, mutual funds only allow for end-of-day trading. Remember, while you can place an order to buy or sell your shares anytime during market hours, the transaction only takes place after the market closes based on that day's calculated NAV. You don't get real-time price execution during the day.
Right, only priced once a day.
Correct. That differs significantly from trading individual stocks or ETFs, where you see the price change constantly and can trade instantly at the current market price.
Now let's tackle the F word, fees. This is a topic that, yeah, it often makes investors' eyes glaze over, but you've stressed how important it is. How do these fees work, and how much do they really matter when it comes to my returns over the long haul?
You're right, it's not the most glamorous topic, but understanding fees is absolutely, positively critical because they can significantly erode your investment returns over time. Think of them like termites silently eating away at the foundation of your investment house.
Ooh, that's a good visual.
And the really tough part. Fees are assessed regardless of the fund's performance, meaning you pay them even if the fund loses money in a particular year. So minimizing them is crucial. The most important ongoing fee to understand is the expense ratio.
Expense ratio.
This is an annual fee that covers essentially all of the fund's day-to-day operating expenses. This includes the management fees, which pay the fund manager and their research staff, administrative costs like record keeping, accounting, legal, trading costs within the fund, marketing expenses, and other operational overhead.
So all the running costs bundled together.
Exactly. It's expressed as a percentage of the fund's average net assets over the year. For example, we saw funds with expense ratios like 0.04% or 0.50% or maybe even 1% or higher. A 0.50% expense ratio means you pay $5 annually for every $1,000 invested. Now, that might sound small, like just 0.5%, pocket change maybe, but compound that over 20 or 30 years of investing, a difference of just 0.5% in annual fees can literally cost you tens, even hundreds of thousands of dollars in your potential retirement savings due to the lost growth on the money paid out in fees.
Wow, 0.5% makes that much difference.
Over decades, absolutely. The impact of compounding fees is enormous. That's why paying close attention to the seemingly tiny percentage is one of the most powerful things you can do for your long-term wealth. Because every dollar you don't pay in fees is a dollar that stays in your pocket, working and compounding for you. The good news, as we mentioned, is that largely due to fierce competition from low-cost index funds and ETFs, the average expense ratios for mutual funds have thankfully fallen significantly by more than half over the last 30 years. That's a very positive trend for investors.
That is good news. What about other fees, like those loads you mentioned?
Right. Besides the ongoing expense ratio, some mutual funds, particularly actively managed ones sold through certain brokers, charge sales charges, which are commonly known as loads. Think of these as commissions paid for buying or selling the fund.
Commissions.
There are primarily two types. Front-end loads are charged when you buy shares. This percentage, which can be maybe 3% to 5% or even more, is deducted directly from the amount you invest before your money even goes into the fund. So if you invest $1,000 in a fund with a 5% front-end load, only $950 actually gets invested to start working for you. $50 goes to the salesperson or brokerage firm.
Ouch, losing money right off the bat.
It's a significant hurdle to overcome from day one. Then you have back-end loads, which are also known as contingent deferred sales charges or CDSCs. These are assessed if you sell your shares before holding them for a certain number of years, often on a declining scale. For instance, the load might be 5% if you sell within the first year, 4% in the second year, and maybe drop to 0% after 5 or 6 years. It's designed to encourage long-term holding.
So penalties for selling early.
Exactly. However, it's really important to know that many mutual funds, especially those offered directly by large fund families like Vanguard, Fidelity, and Schwab, are no-load funds. This means they do not charge these upfront or deferred sales commissions. You might still pay a small annual distribution fee, sometimes called a 12b-1 fee, bundled into the expense ratio, but you avoid those hefty sales charges. These no-load options are often strongly preferred by cost-conscious investors for obvious reasons.
Definitely seems better to avoid loads if you can. Are there any other fees?
You might occasionally encounter redemption fees. These are different from back-end loads. Some funds charge a small fee, typically limited to 2% by the SEC, if you sell your shares within a very short period after buying them, maybe 30, 60, or 90 days. This isn't designed to generate profit for the fund company, but rather to discourage rapid short-term trading or market timing, which can disrupt the fund's management and potentially harm long-term shareholders.
Okay, discourages quick flipping?
Right. And beyond these fund-specific fees, be aware that some brokerage firms might charge other account fees, like annual maintenance fees, especially for small accounts, fees for specific transactions, or fees for closing an account. It's always good to understand the fee schedule of both the fund and the brokerage you're using. And just to add one final layer of potential complexity, though hopefully not too much, a single mutual fund might offer several different share classes. You might see letters like Class A, Class B, Class C, Class I, Class R.
Oh boy, alphabet soup. What does that mean?
Don't let the letters intimidate you. Think of these simply underlying mutual fund. They all hold the same portfolio of investments, are managed by the same team, and have the same investment objective.
Same fund, different prices.
Essentially, yes, different fee structures. They come with different combinations of front-end loads, back-end loads, and ongoing annual fees, expense ratios, and 12b-1 fees. This leads to slightly different net asset values, NAVs, and ultimately different performance results for the investor, even though the underlying investments are identical. For instance, Class A shares often have that front-end load but might have lower annual expenses. Class C shares might have no front-end load but higher annual expenses and maybe a back-end load for the first year. Class A shares, I for institutional, are typically for very large investors like pension funds, have very high minimum investment requirements, but usually have the lowest expense ratios and no loads.
So you really need to check which class you're buying.
Absolutely. The key takeaway here is to always understand which share class you're being offered or are considering, and look closely at its specific fee structure, the loads, and the expense ratio before you commit your money. Because those fees directly impact your net returns over time. Don't just assume all share classes of the same fund are equal for you.
That's a really important, subtle point. Okay, switching gears slightly. I've heard of diversification. Obviously, we've talked a lot about it. But what's diversification? It sounds like the opposite and probably something I should actively try to avoid.
Yes, diversification. It's a playful but very serious term, often attributed to the legendary investor Peter Lynch. It refers to the situation where investors, in an attempt to diversify even further, actually make their situation worse by adding too much complexity that doesn't actually reduce risk or improve returns.
How does that happen?
Many investors make the mistake of acquiring too many mutual funds that are actually too similar. They might end up owning, say, 5 different large-cap U.S. stock funds, maybe a couple of S&P 500 index funds, and another couple of large-cap growth funds.
Owning the same stocks over and over again.
Exactly. They look diversified because they have lots of fund names on their statement, but under the hood, they likely own many of the same big companies like Apple, Microsoft, Amazon, multiple times across those different funds. This overlap means they aren't achieving meaningful additional diversification. Instead, they've just added complexity to their portfolio, making it harder to track. And crucially, they're often just paying multiple sets of fees without getting any real benefit in terms of better risk-adjusted returns. It can actually lead to worse results than holding just 1 or 2 well-diversified, low-cost funds.
So more isn't always better.
Definitely not. The real insight here: don't confuse complexity with sophistication. Simplicity and clarity in your investment portfolio are often your best allies. Understanding what you own, why you own it, and keeping your costs low is usually a much more effective strategy than collecting dozens of overlapping funds just for the sake of having more. Avoid diversification.
Great advice. Keep it simple. Okay, last potential pitfall area. What about taxes? That's always a big concern for investors. And it seems like mutual funds might have some unique tax implications compared to just holding individual stocks.
Taxes are definitely a big concern, and yes, mutual funds have a specific feature here that's crucial to understand, especially if you're investing outside of a tax-advantaged retirement account like a 401k or an IRA.
Okay, what is it?
Here's the key point. Remember those capital gains distributions we talked about? When a mutual fund manager sells a security within the fund's portfolio for a profit,
Yeah.
a capital gains tax liability is triggered at the fund level. This capital gains liability is then required by law to be passed through and distributed to you, the individual shareholder, typically once a year.
Okay, good.
So this means you might receive a taxable capital gains distribution and owe taxes on it, even if you haven't sold any of your own shares in the mutual fund during the year.
Wait, I can owe taxes even if I didn't sell anything.
Correct. This is a major difference from holding individual stocks, where you typically only realize a taxable capital gain when you personally choose to sell the stock for a profit. With mutual funds held in a regular taxable brokerage account, you can face tax bills due to the manager's trading activity inside the fund, regardless of your own actions. These are sometimes called phantom gains because you get the tax bill without actually selling shares yourself.
That seems kind of unfair. How can I avoid that?
It can certainly be an unwelcome surprise if you're not expecting it. You can potentially lower this tax burden in a few ways. Some fund companies offer tax-managed or tax-sensitive mutual funds that actively try to minimize these taxable distributions by being careful about when they sell winning positions. But the most common and powerful strategy is to hold mutual funds that tend to generate significant taxable distributions, like actively managed stock funds, within a tax-deferred or tax-advantaged retirement account. Think accounts like a traditional 401k, a traditional IRA, a Roth 401k, or a Roth IRA.
Hold them inside their retirement accounts.
Exactly. Inside these accounts, the annual capital gains distributions, as well as any dividend income, typically aren't taxed in the year they are received. The taxes are deferred until you withdraw the money in retirement, in the case of traditional accounts, or potentially avoided altogether, in the case of Roth accounts, if rules are followed. This is a major reason why retirement accounts are such popular and effective vehicles for holding mutual fund investments. They shield you from that annual tax drag from internal fund transactions.
That makes perfect sense why they're so common in 401ks then.
Yes.
Okay, we've covered the nuances, the benefits, the risks, the fees, the taxes, a lot of ground. Now let's briefly compare mutual funds to their close relatives, the ETFs, because that is such a common point of confusion for many investors and definitely something our sources spend time clarifying. We know mutual funds and ETFs are often compared, and people sometimes use the terms almost interchangeably. So what makes them so similar that people often get them confused? What's the shared core between them?
They are indeed very, very similar in their fundamental purpose, which is absolutely why the confusion is so common. Both mutual funds and ETFs, exchange-traded funds, are types of pooled investment funds.
Cold money again.
Exactly. They both allow you to invest in a diversified portfolio of securities, stocks, bonds, etc., with a single purchase. They both offer access to a huge variety of U.S. and international stocks and bonds, giving you incredibly broad market exposure very easily. And critically, they both generally benefit from professional management, whether that's active stock picking or, more commonly these days for both, passive index tracking. This management saves you immense time and effort compared to trying to build and maintain your own diversified portfolio from scratch.
Okay, so same basic idea. Diversified asset, professionally managed.
Precisely. In fact, many major fund providers like Vanguard or Fidelity or Schwab offer both mutual funds and ETFs that track the exact same underlying index, holding essentially the same basket of securities. So their fundamental purpose of providing diversified managed investment exposure is virtually identical in many cases.
So if they're so similar in purpose, what's the big difference? Or maybe the key difference is that an everyday investor really needs to understand when choosing between them. Where do they actually diverge?
The most important distinctions really come down to how they trade, how their prices are determined throughout the day, and what that means for your investment style, and potentially some other factors like minimums and taxes. Let's start with trading and pricing. ETFs, exchange-traded funds, trade throughout the normal stock market trading day on major stock exchanges, just like individual stocks. Think Apple or Google stock.
So you can buy and sell ETFs all day long.
Exactly. This provides real-time pricing. Their price can change minute to minute, even second to second, as buyers and sellers interact in the market. You can execute a trade to buy or sell an ETF almost instantly at the current market price during trading hours. This real-time trading capability also allows for more sophisticated order types that stock traders use, like limit orders, where you specify the maximum price you're willing to pay or the minimum price you're willing to sell for, or stop orders, which trigger a sale if the price drops to a certain level. You have more control over the execution price if you want it.
Okay, ETFs trade like stocks, real-time prices. How about mutual funds again?
Mutual funds, on the other hand, as we've established, are priced only once per day after the market closes, typically 4 p.m. Eastern, based on their calculated net asset value, NAV. Regardless of when you place your buy or sell order during the day, 10 a.m., 2 p.m., your transaction will receive that single closing NAV price determined later that afternoon. So with a mutual fund, you don't get that real-time price execution or the ability to trade intraday at fluctuating prices.
So, big difference in how they trade and get priced.
Huge difference, and it often comes down to preference. If you're someone who likes to actively watch prices, maybe trade more frequently, or wants precise control over your execution price, an ETF might appeal more. If you prefer a simpler, hands-off approach, maybe you're investing automatically every paycheck and you don't need or want to watch intraday market movements, then a mutual fund's end-of-day pricing is perfectly adequate, perhaps even preferable for its simplicity. Another practical difference often lies in minimum investments.
Yes, the minimums.
ETFs generally have much lower or even no practical minimums beyond the price of a single share. You can often buy ETFs for the price of one share, which might be $50, $200, whatever it is. Some brokers even allow you to buy fractional shares of ETFs, meaning you could potentially invest as little as $1 or $5.
Very accessible.
Extremely accessible. Mutual funds, however, traditionally have had higher initial investment minimums, often, as we said, maybe $1,000 or $3,000 for many popular funds, especially for the share classes with the lowest expense ratios. While some fund providers are now offering lower or no minimums on certain mutual funds, like the Fidelity Zero funds we mentioned, the general tendency is still for mutual funds to have higher starting requirements than ETFs. This can be a significant factor for new investors just starting out with smaller amounts. Then there's automatic investing.
You said mutual funds are good for that.
Historically, yes, setting up automatic recurring investments, like investing $100 every month, was much easier and more commonly done with mutual funds. You just set the dollar amount. For a long time, doing automatic investing with ETFs was trickier because you typically had to buy whole shares. However, this landscape has evolved rapidly. With the rise of fractional share trading, many major brokerage platforms, including places like Vanguard, now do allow you to set up automatic investments into ETF positions too, using dollar amounts, effective from early 2025 in Vanguard's case. So, this historical advantage of mutual funds for automation is becoming much less distinct. ETFs are catching up fast here.
Good to know that's changing. What about taxes? You mentioned mutual funds have that pass-through issue. Are ETFs better?
This is a subtle but potentially important difference, especially if you're investing in a regular taxable brokerage account, not an IRA or 401k. ETFs may offer an additional layer of tax efficiency compared to mutual funds.
How so?
It relates to how they are structured and how shares are traded. When ETF shares are bought and sold, it typically happens directly between investors on the secondary market, the stock exchange. The ETF fund manager usually doesn't have to sell the underlying securities within the fund's portfolio just because investors are trading ETF shares with each other. Mutual funds, however, have to directly buy or sell their underlying securities when investors put money in, buy shares, or take money out, redeem shares. This internal buying and selling by the mutual fund manager is what often triggers those taxable capital gains distributions that get passed through to the shareholders. Because ETFs generally have less of this internal selling forced upon them by investor flows, they tend to generate and distribute fewer taxable capital gains year after year compared to similarly managed mutual funds. This can be a significant advantage for ETFs held in taxable accounts, potentially leading to lower tax bills over time.
So ETFs might save you on taxes in a regular account.
They might. It's not always guaranteed, and it depends on the specific funds being compared. But generally speaking, ETFs often have a structural advantage when it comes to tax efficiency in taxable accounts. So putting it all together, this comparison really shows that the better choice between a mutual fund and an ETF often depends heavily on your personal investment style, your preferences, and your specific situation. If you value intraday trading, real-time pricing, potentially lower minimums, and maybe enhanced tax efficiency in a taxable account, an ETF might be the more suitable choice for you. If you prefer the simplicity of end-of-day pricing, perhaps appreciate the long history and structure of mutual funds, find a specific mutual fund with features you like, maybe a lower minimum or a unique strategy. Or if you're investing primarily within a retirement account where the tax efficiency difference is less relevant, then a mutual fund could be a perfectly good or even preferred fit.
They both serve similar core purposes, but cater to slightly different needs and preferences. That makes sense.
Exactly. They're more like siblings than distant cousins, very closely related but with distinct personalities.
Okay, wow. That was a true deep dive into the world of mutual funds. We've covered so much ground: what they are, how they work, their numerous benefits, the potential pitfalls, and those crucial fees to watch out for, and even how they stack up against ETFs. So what does this all mean for you, our listener, as you navigate your own financial journey? We started this deep dive by acknowledging that jargon barrier, that feeling of overwhelm that often stops people from investing. And our goal was really to demystify mutual funds. We hope you now understand they are essentially these diversified baskets of investments, professionally managed to save you time, effort, and potentially money through diversification and scale. We really hope you now feel much more informed and confident about this essential investment vehicle.
Absolutely. You've learned about the incredible power of that built-in diversification that mutual funds offer, how it works to significantly lower your investment risk compared to picking individual stocks. You've also discovered the three primary ways you typically gain returns: through dividend and interest income, through those capital gains distributions from the fund's trading, and ultimately by selling your own shares at a higher value down the road. We've explored the wide variety of fund types available, from those convenient, hands-off target date funds that automatically adjust for your retirement timeline, to the super low-cost and popular index funds that just aim to match the market, and more specialized bond or money market funds for different goals. And crucially, you're now well aware of the importance of looking closely at the various fees, especially that expense ratio and any sales loads, and understanding the inherent risks, like the fact that they're not FDIC guaranteed. These are absolutely vital considerations before you invest a single dollar.
Our goal throughout was to make this topic simple, easy, and accessible. And we truly hope that you now have a strong, well-informed foundation to stand on. Mutual funds are genuinely versatile tools, and they make diversifying your portfolio and participating in the markets achievable and much less intimidating, even if you don't consider yourself a financial expert. They can be a real cornerstone of your financial plan, especially for long-term goals like retirement, offering a powerful way to grow your wealth over time with professional guidance and built-in risk management.
And this really raises an important question for you, the listener, to ponder. Now that you have a much clearer understanding of the mechanics, the variety, the pros, and the cons of mutual funds, what is your next step in exploring how they might fit into your own financial journey? Does understanding these fees, for instance, make you want to take a closer look at the funds you might already be holding in your 401k or IRA to see if they're truly cost-effective? Or perhaps you're now curious about a specific type we discussed, like a target date fund to simplify your retirement savings, or maybe a broad market index fund to get low-cost diversification, and you want to explore those options further. Remember, knowledge is most valuable when it's understood and then applied to your own situation. What will you do with this information?
We hope this deep dive has given you the clarity and the confidence to take that next step, whatever it may be for you. Thank you so much for joining us on the deep dive. We'll be back soon with another exciting topic to explore.